income-focused securities, bonds, preferred stocks, they're not sexy at all. They don't make these big. I own just under 100 closed-end funds, totally invested in the stock market. Totally. So they'll own Berkshire Hathaway, they'll own Nvidia, they'll own Microsoft, they'll own things that are $200, $300 a share. There's not one of those funds that costs as much as $45 a share, even though it contains things that are much higher in price, because they just don't. When the trust vehicle, the pass-through trust, has to pay out 95% of its net income to the shareholders, So there's no way you can grow a business, grow market value of a business, if you have to give out 95% of your net earnings each year.
Hey there, and welcome to Money and You. I'm Michelle Perkins, your host. My search for more fulfilling work led me to career and business coaching, where I stumbled upon a game-changing discovery. Money issues often start with our mindset and habits. You see, our relationship with money is the key to overcoming those frustrating financial obstacles. As an entrepreneur, coach, and problem solver, I'm passionate about helping you create a great relationship with money. Because, turns out, that's the foundation for a limit-free life. Each week on Money and You, I speak with amazing guests about all things money, mindset, practical tips, and everything in between. We're here to give you new insights, education, and empowerment so money can be one of your favorite relationships. So join us for some lively conversations and let's transform your financial life together. Hello, hello. Welcome to the Money and You Show. I'm Michelle Perkins, your host. Very glad to be starting 2025 with a couple of, several really wonderful shows. And today's show, we are featuring a guest who I was very excited to speak to earlier and couldn't wait to bring him to you. I think you're going to get some real insights. And I love when I've done so many shows and I don't know how many now, Tony, a couple hundred maybe, 162 of Money and You Show. Okay. There was a show, Limit Free Life show before that with a couple hundred shows. But I'm fascinated when I meet somebody who's going to come and talk about something we've really never talked about. And that's what we're going to do today. So, there's a lot to cover in the world of money. So I'm going to introduce you to Steve Selengut, who is a private portfolio investment manager with over $110 million in assets before selling his business in 2023. He's introduced several proprietary concepts, including QDI and PT, Smart Cash, the working capital model, the investor's creed, base income, and the investment grade value stock identification system. We'll be sure to ask him about some of these. As a 44-year-old investment professional, he's developed a simple yet little-known system for producing reliable market-generated income. He created income-generating portfolios for his clients for decades, growing their income every year. Now semi-retired himself, his mission is to bring this system to as many investors and retirees as possible. So we're going to learn a lot more today from Steve. Welcome, Steve.
Well, thank you. Good to be with you.
Yeah, great to have you here. I was really inspired when we spoke before, and I really am delighted that you can be here and share some of this, your wisdom with some of our guests, or our listeners. Sorry about that. Tell us a little bit. When I originated this show, a lot of it was to address this idea that people have a relationship with money, and sometimes they don't realize it at all, and sometimes they don't understand it. And so this idea of how they relate to money and how they think about money and what they believe about money, I think is so important before they get rolling on, building wealth and creating all the foundational things that one needs to be, financially independent. So what would you say over the years with all your experience? What do you think is a way to have a good relationship with money?
Having a good relationship with it, I guess it's almost like having a relationship with a business partner, or even better, with people who are working for you. and you're a team. The team concept works well, particularly in small businesses. And I got to think early on that I was fortunate. I had some money. When I was 25, I got some money, and I said, I know this money can send me dividends and things like that, but I want it to be more like a business that I'm running. That I want to see if I can make as much money with this operation, this business, as I do with this, this not so great job I have in Manhattan that I have to get up at 5 o'clock in the morning, get on a bus and go to Port Authority, then walk up, a not so nice 8th Avenue in those years. And, and that type of thing. What can I do with this money? I want to make this money work. And that's really my first relationship I was very fortunate. Like I said, I didn't have to concern myself about it in the early days, and the important time of your life when you have to make the decisions about college and profession and marriage. I really, I was fortunate. But I didn't have any real assets that I could say could be considered money. And then I got them. And then I said, well, I guess the key is you got to do something where you're not risking it a whole lot and you're making it work for you. And I think that making it work for you is the most important thing. Money can be a hardship when you don't have it, because you have to take steps to get to a point where it's coming in. Mm-hmm. But once it starts coming in, you have to realize that just spending it doesn't do a thing for you.
Yeah.
You got to set aside some of it. You got to put some of it away and start it working. And eventually you get to the point like where I did, where you had this pot of money in the form of New York Stock Exchange stocks, generating more money than you were getting in your check from your employer each month.
Wow.
That's where you want to get to. And it wasn't easy. It didn't happen overnight. There weren't a whole lot of, back in 1970 when I was in this position, there weren't the overnight heroes like you have today where things would go. I mean, there are very few stocks that sold for over $100.
Wow. Yeah.
So back in the day, there were never 1 million shares exchanged on a New York Stock Exchange. There were no double-digit indices and stuff like that. So it was a whole different ball game. And to me, I slowly and consistently added to the part of my investment portfolio that generated income. And like I said, I didn't have to spend it, so I was able to reinvest it. And I grew a significant portfolio in what even now would be considered a pretty short period of time.
Yeah.
By some of the things you mentioned earlier about the market cycle and investment grade value stocks and working capital model, those three things were really the key because it made me look at things other than just the changes in market value. I was paying attention to a lot more than that. I was paying and I had a mindset that was focused on income instead of on building the value of a portfolio that doesn't do anything but sit there and look pretty. I didn't want that. I wanted one. I didn't care how ugly it was. I wanted it to pay me money, no matter what, up or down in price. I wanted to generate money. And so I learned when it went up in price, it was a simple matter just to sell it, take the profit. And I had a target at that time of 10%. And then I'll find another stock that's paying a dividend, and I'll do the same thing over and over. And I'll look at where it is in its range, and created what I called a universe of stocks that met my requirements for quality and diversified types of companies and so on. And when I sold my Esso, that's how old I am. It was Esso, not Exxon. When I sold that, then I'd find some Mobil oil to buy, or I'd put it in Shell. If I sold one of the healthcare companies at a profit, I'd find one that was a little bit lower than it's been, and I'd buy that. And I just did the same stocks over and over. And I developed another side of the portfolio, which I call the income purpose side. And this side isn't as risky as owning stocks. Not that the ones that I invested in were very risky. They weren't. But you started to learn about corporate bonds and mortgage type investments. And in those days, there was a thing called Ginnie Mae's, Government National Mortgage Association, I think it was. And you could buy all these income producers, and some of them would actually give you back principal with each payment, and that's really a good thing. And, so you just developed cash flow. And when it comes to money, if you look at any success, and this is very ironic what I'm going to talk about. You look at any successful business, from your NVIDIA, which hasn't paid a dividend yet because of this concept, to the mom and pop pizzeria on the corner. Cash flow. Cash flow. You gotta have cash flow. And so that's what made all these companies what they are today, all those big hitters, those wonderful companies that we have in our economy. They've gotten there because of the cash flow they've developed. And yet our investment community doesn't say to investors, just like they did, you should be building your cash flow. They say you should be focused on developing your market value. Income doesn't matter. And that's just the big irony, the big discrepancy between what you hear basically in the news and the way I've managed money over the years for my clientele.
So interesting. Yeah, I love your answer to the relationship with money question. I'm just going to go back to that for a minute, because I love that you think of money as a business partner. I mean, I think that's the way, if people did think of it more like an ally or a support in their life versus something that is almost against them. I think people feel like this, money is the challenge of their life. And so that was a great way to describe a relationship with money. But when you started out, I mean, you were young, and immediately I was thinking, a lot of young people are going to get a chunk of money and just either enjoy it and spend it, or, you seem to know how to do this, or at least know to do this. Where did that come from?
How'd that happen?
Yeah.
Okay. Well, that was because of where I happened to land. My dad was a real estate developer and builder, and I don't know if you're familiar with the term vertical integration of a company. It's in economics we were taught how, the more a successful company will have access to all it needs to run its business, so that it doesn't have to depend it's on stuff coming from somewhere else,
right,
to just get started. So, for example, he was a builder, so he owned a lumberyard. Yeah. So he wasn't ever going to get caught short of materials to build a house with. They were going to be there, and of course, he was going to make money when the people who worked for them, the contractors, bought it. So he had that. He, of course, had the land, and he built the buildings. And then when he sold the buildings, he took the mortgages back.
Wow.
A lot of them were the people weren't ready to do that themselves, and he'd undercut the bank, and he'd do the mortgage. So no matter what was going on, he always had monthly income coming in. And then he had rental properties as well. So Bad time to sell houses. He didn't care because he had other sources of income. He had an insurance agent in his firm that took care of the homeowner's insurance and some of the other insurances.
Yeah.
No health care or life insurance, but just home and auto is basically what he did. So I learned that early. And what he told us, my brother and I, when we got our summer jobs and things like that, he says, you don't pay any rent, but 25% of whatever you make, I'm going to put away and have somebody invest for you.
Wow.
And that's where the money came when I was 25. It came from the investments of actually from 13 years of my labor in the summers, basically.
Wow.
It came from. And
Okay,
that's
very
that's where
interesting.
and I had no knowledge of what he was doing with it at that time until the stock certificates were dumped on the table at my 25th birthday party. That was basically it. Here you are, kiddo. Now it's yours to run.
So interesting. Okay, I love that. Okay, so how did you? So you watched him, and you got this idea of this income model, and then
the income part of the model. How you got it? I had no interest in being in the real estate business, and mainly because of all the planning board type stuff.
Yeah.
To get variances to build this type of house or just things of all those different natures and the rules that started to come down the line in those when he first started in the 50s. There weren't a whole lot of rules on builders. You didn't see any of those neat fences up that kept the drainage from going down the road and stuff. That didn't exist. There was none of that. But but there were rules being coming, and there were planning boards and people who started to tell you what you had to do and how you had to build and, this type of thing. And I didn't want to be involved in that. I didn't want to go out at night to a planning board meeting.
Yeah.
Stuff like that. So I decided I would, and I didn't decide, I was probably, until I was 25, I really didn't have any big direction, knowing that I was going to become an investment manager. That happened. That was the eureka moment when I realized I could quit my job and still live the same lifestyle my wife and I were, and develop a business. That's
So was it from your own, like teaching yourself how to do this, then you decided to help others, or was it the other way around? When did you become a financial?
I learned about investing mostly through this woman I met, when I called up to find a stockbroker. She was the one that got on the phone. It was her turn in the rotation to get the call. And I told her I had this pretty substantial, in those days, amount of money, and it was all in stocks, and I had the certificates, and I wanted to, how do I deposit them? How do I get an account started? And she just walked me through it. She saw what I had. We talked about the quality. We talked about the diversification. We talked about the income, that they're all thing. The only thing we didn't talk about was profit taking. The only thing we didn't talk about, the QDI plus PT that you mentioned earlier.
Yeah, tell us what that is.
Those are the four basic ways to minimize the risk of your portfolios: the essential quality of the companies, the diversification among many different industries, sectors, and so on, the income they produce that they actually give to you, not to their chief executive officers. You, the owner of the company, is going to get some money, and the PT was something that we developed a little ways in, where we started looking. You look at a chart of any company and you say, well, it's going like this, and it's a general upward trend with the good dividend paying companies. But in a year there'd be 100, 200 different times where there'd be a 10% movement from the low to the high. And I said, what if every time one of these companies I own now gets a 10% profit, we're going to sell it. And we're going to find more companies like this, the universe that I developed, that I talk about, that she and I developed actually, and we'll buy something else and that's down in its cycle, and we'll do the same thing over. And that's when we did. And she'd point out to me, oh, this one's up, or hey, we got a bargain on this one. Maybe we should take a smaller profit on this one and pick up this one. Yeah, good idea. And I said, well, what are we doing about bonds and stuff like that? Mutual funds weren't a big deal then. There were no ETFs.
Yeah.
There were no IRAs, 401ks, any of that stuff. It was all just, and everything was done. You wrote a ticket out when you made a trade. The broker wrote it and ran across the office to the desk where they'd, in a teletype thing they'd send it in.
Love it.
And there really were people in the exchange yelling and saying, hey, I got this. So it's a long time ago. But anyway, she and I developed this approach, and we grew that portfolio like Topsy.
Wow.
It was amazing. It was amazing.
So do those principles still apply with all the new things that have come along?
Absolutely. Absolutely. Right to the current day. I haven't bought a common stock in maybe 20 years.
Wow.
I now use closed-end funds, which pretty much contain all the stocks you could possibly own on the equity side. And they also... They're also wonderful because in the bond side and the income side, they're portfolios of bonds and preferred stocks and mortgages that trade like stocks. So I don't know if you're familiar with how difficult it is to actually own and trade individual bond securities, but it's really a real pain in the neck.
Okay.
To get quotes, and particularly since most people are buying small quantities. A round lot in a bond is like $50,000. There weren't a whole lot of my customers that even were worth $50,000 when I started.
Wow.
So so when I found about closed-end funds many years later, again, it was one of these things. Wow, I can own a portfolio of 350 municipal bonds from all over the country. And if the price goes up, I can push a button here on my machine and sell it, just like a stock. That's a eureka moment for you. I said that twice. I shouldn't. Anyway, there was a lot going on that brought about this structure, this approach. And yeah, today the same thing applies. It's important to know the quality of anything you buy. I mean, if you don't understand what the company does, you don't buy it. If you don't understand what the potential ups and downs are for the type of business or industry it's in, you don't buy it. If it doesn't pay you a dividend, if it hasn't been in operation in closed-end funds, I won't buy anything that hasn't been around for 5 years and it's had to have a dividend history in 5 years.
Can I ask you about the dividends? Because I do think I watch my son invest, and like dividends are pretty much the last thing that he's looking for, he follows a lot of different trends, but he's pretty smart for his age, 27, on what he's doing. He studied up a little bit, but I was starting to get the impression that maybe fewer and fewer companies were offering dividends. But what's the situation with dividends these days?
Oh, there are probably hundreds of different companies. When I was doing dividend stocks, there were probably, I think, between 200 and 250 that were in our universe that we were comfortable owning.
Okay.
I'm sure there are more than that now.
Okay.
It's, to me, it's the most important thing of all is that you have cash flow. I mean, it's the money thing again.
Yeah.
You could have $1 million portfolio. I've seen $1 million portfolios that own 3 different stocks, none of which pay dividends. Mm-hmm. This guy's about to retire in 5 years. He's got no income from his portfolio. Mm-hmm. So he's got to change. He's well, I can't sell it. I've got all this profit. I'm going to have to pay taxes. I said, well, you got bad advice, man. You got to take your profits every year. You pay a little bit of taxes and then you own it, you know. But it's very income is not special except to the companies themselves, like we talked about earlier, that, you know, they're in the business of producing cash flow. And I hate to say this, and I don't know if your son is in the business or not.
No.
But the people who are running the business, not necessarily the people that you're going to deal with if you go out and hire a advisor. I'm sure that most advisors are 100% interested in helping you. But the owners of the companies are interested only in the amount of market value that you manage. They could care less if it produces a penny of income. And in fact, income securities generally do not have the robust price advance histories as growth type securities, like companies on the NASDAQ exchange, the NVIDIAs that probably is the biggest net worth company maybe in the world, or has been from time to time over the last few years. It's never once paid a penny of dividends to its client, to its owners.
Yeah.
You know, that's not to say that the senior owners and officers haven't gotten wealthy on it. They have. But the shareholders, the public shareholders, only if they sell it do they make a penny.
Yeah.
And then, of course, they have the tax issue, which I don't really care a whole lot about taxes. Well, really, I mean, it's a 30% maximum tax in this country. So if you make $100,000 in profits that you wouldn't have had, that's 70,000. The net is 70,000.
Yeah.
You know, is it better just hold on to that profit and not pay and watch it go away like it's leaving us right now? People are all excited that the market's going down. I'm not. I don't care. I've already taken my profits. I took them on the way up, and now I'm putting the income that my portfolios are generating. I'm buying these things cheaper.
Yeah.
And when they go back up again, I'm just going to sell them again. You know, it's a whole different way. I operate my portfolios like a department store.
Interesting.
It's a department store.
I love that. That's a great analogy too. So now you've written a book. Does your book describe this process so people could learn more about it?
Step by step in a conversation just like you and I are having now.
Okay.
It's my wife and I meet this couple on a Viking cruise starting in Amsterdam. And similar to the one we're going to be on in April.
Oh, good.
And we talk. And we talk about how he paid for the trip and how I paid for the trip. And the differences. And what difference does it make to their well-being? Do they lose sleep at nights because they had to pay $35,000 to take this 2-week adventure? And I didn't have to because my income paid for it.
Yeah.
You know? So
how does that shift your whole mentality around retirement? Because I think this conversation is fascinating with, you work for X amount of years and then you retire and you don't even necessarily, I just had another conversation about planning for other things than retirement, like catastrophes like we're having right now. And, so how, if you're consistently earning income from your investments, you're sort of, you can ride whatever waves, it seems like.
Exactly. I mean, right now, there's two types of people that need to focus on income critically: the pre-retiree and the business owner who knows that he's got to sell that business to retire, or the employee who is working for somebody and would rather have their own business. How do I get from A to B? Because some of these people are making huge salaries and they're investing them, but the investments aren't generating enough income that they can say goodbye, like I did to my job in New York. It didn't matter how long it took me to get that that business going, because I was making, literally 4 or 5 times my salary that I was making before. My wife is still working, so we had plenty of money. Even I was unemployed. I had 2 clients at the start. When I was managing maybe less than 100,000 of other people's money at that point. And,
wow. Okay.
My first 2. So you got it. When you have the opportunity to build that income, you got to take that opportunity. You got to focus on it, and you can't dip into it just because you'd like to have a Jaguar instead of a Chevrolet. Mm-hmm. You really have to build it if you want to get where you want to be. And I wanted to get the heck out of Manhattan, frankly, and I did. And then 2 years ago, we sort of decided that my partner, it wasn't actually a partnership, but the guy who was my broker, the woman who I started with retired. And I went to this guy who was actually a part-time bartender at a restaurant my wife used to go to. And we used to talk about money, and he was a broker. And finally, when she retired, I brought all my business to him. Huh. And in the 80s, mid-80s. And we were in business together until 2023. Wow. When we sold the business. And at that point, this is the second time around, If I sell the business, I'm still traveling all over the place. I'm still spending much too much money. Is my portfolio going to be enough to do it? And with the total sum, I could say, yeah, that's plenty. I'm happy. I'm smiling. But when you found out that you got half of it up front, a little more than half of it, but the rest of it wasn't going to be there for 12 to 18 months because you had to prove that you weren't going to have to try to steal their clients from them, to get your clients back and go into business against them or stuff like that. Mm-hmm. I mean, I'm still under those rules, right? Non-compete type stuff. But then you have to say, okay, now if I've only got this much plus what I've already got, is that going to be enough? Or am I going to spend half of it before I get the rest of it, and then it's not enough? So that's, you have to get that income to be into the point where you can say, yeah, I can take this deal and I can take it on your terms and it's not going to bother me.
Well, you brought up a couple of things I want to ask you about. So first of all, this idea of what's enough. I mean, how in the world does one figure out what enough is? I mean, so you're not just chasing more money for the rest of your life. And B, so that it's, it really is enough, so that you're not suffering either.
Yeah. I think there's a couple more things. I think a lot, like with my approach, since it's so different, I'm not making the same kind of money I was making when I was managing other people's money now, but I feel like I'm introducing a lot more people to a different approach. Mm-hmm. And that's kind of, when you get to be almost 80, you got a legacy thing starts to take over your thinking. If you think you've done something that's worthwhile, you really want to get it out there. Even though I'm not going to make, my book sales have been good, but
good.
My net from a book sale isn't going to buy a lot of meals,
But I like what you're saying, because your enough can also change throughout your life. I mean, what's enough at 40 is going to be different.
Changes into, I've got enough, but I want to still accomplish more, not necessarily with a monetary effect.
Yeah.
So, but the enough for me was, if my wife comes up to me and she says, I'd really like to go spend a month in the Bahamas, and you can say, sure, go ahead. I mean, yeah, let's do that.
Yeah.
Let's just find a month,
Yeah.
That's where you want to be. You want to be able to do what you want to do. Even if it's, I want to take my grandkids to Disney World. Mm-hmm.
Right.
That's, whatever you want to do, you want to be able to do it.
And do you, throughout the years, did you talk to people about what it is they want? Because I love this idea that, first of all, we have to think about what we want and what enough would look like, because it really is different for everybody. And so how did you guide people through that thought process?
Well, when you interview, actually, I guess the prospective management client is really interviewing you. Mm-hmm. But you got to interview them to find out what those numbers are, what they want, what they need, how much do they spend a month, what do they want to do? Do they, and then you say, okay, yeah, I can make you that much money a month, no problem. We're going to do this, and that, and if they agree, then you had a relationship going, and that was pretty easy. But there were some people who would come to me and say, hey, did you hear about that new issue, such and such? I want you to buy me some of that. And I say, I'm sorry. Do you have some money somewhere else that you can get some broker to do that for you? Because that's not going to get you, chances are that's not going to get you where you want to be, because it's a speculation on what's going to happen in the future. And it doesn't pay any income. And I don't invest in anything that doesn't pay income.
Interesting.
So,
okay.
You're welcome to do what you want, but I'm not going to do it for you. I had Bitcoin people who left me because I refused to go near it with them.
Yeah.
That's more recent. But yeah,
so tell me this: when you're helping people to earn this income, and then the income's coming in, and you have some cash flow, what do they do with it? So they have income. Then what?
Well, hopefully they keep it with, as a coach, I just tell them there are rules and ways that you reinvest it, what you do first, what you do next. Taking a profit, what do you replace it with? The monthly distributions that come in, they're huge. Mm-hmm. And you can buy something new, or you can add to positions that are down, which a lot of people raise their eyebrows out. Those are your losers. And I said, no, when you're investing for income, there are no losers. Because which way they go in price is totally out of your hands. If the Fed says they're going to lower interest rates, all of these securities that pay a lot of income, they're going to go up in price. Doesn't matter. They're going to go up. But as soon as the Fed says, well, we're only going to reduce it 3 times next year instead of 4, your price is going down. And now they're at 1, maybe not at all. So those prices are going down, but the income continues. It's the same, because these are contracts. When you're buying bonds and preferred stocks and mortgages and rental real estate, which is what's inside these closed-end fund income packages, these trusts, you're not buying the individual securities. You're buying the trust. The securities, even though they go down in price, they're still paying out the same income. And because they've gone down in price, the managers with let's say one of those bonds, $100,000 bond that he bought 20 years ago matures while prices are down, he gets the full face amount. Bonds mature at the face amount. Doesn't matter what they were worth yesterday. They go up to the face amount. So now he's got this, let's call it $2 million. He now can reinvest and buy all those other bonds that are down in price. Mm-hmm. So that's current yield. They go down in price. So, it's a totally different ball game. You've got to understand, like I said before, you got to understand what you own. Mm-hmm. And in my case, and in my investment philosophy, you got to focus on the income that these managers are getting for you, because they're focused the same way.
Okay.
Closed-end fund managers are focused on generating income for their owners. Stock market investors per se in individual stocks, either mutual funds, ETFs, private advisors, and so on, they're focused on generating the highest growth in market value that they can, because that's how they and their owners, mostly that's because that's how their owners get paid. I mean, when we left this, our company the company that bought us required that our portfolios within 5 years had to contain some model portfolios. And they weren't model portfolios of closed-end funds. They weren't model portfolios of anything that paid income. They were just the popular stocks of the day that go into these models, and there's no income incentive at all. So we said, well, there was one guy in the business who was doing a different kind of investment than I was. He'll do all those, you know.
Interesting.
So I've learned since that that might not have been the way it's worked out. But anyway, back to your questioning.
Well, so how is this sort of a lesser used strategy? Because it sounds super smart to me. I mean,
well, I hate to be so cynical, you know, but it's really a matter of the bucks. Income-focused securities, bonds, preferred stocks, they're not sexy at all. They don't make these big. I own just under 100 closed-end funds, totally invested in the stock market. Totally. So they'll own Berkshire Hathaway, they'll own Nvidia, they'll own Microsoft, they'll own the things that are $200, $300 a share. There's not one of those funds that costs as much as $45 a share, even though it contains things that are much higher in price, because they just don't. When the trust vehicle, the pass-through trust, has to pay out 95% of its net income to the shareholders, you know? So there's no way you can grow a business, grow market value of a business, if you have to give out 95% of your net earnings each year. Just can't be done. I mean, think about it. How big would Amazon be if it gave its shareholders 95% of its earnings each year since it started? I mean,
interesting. Yeah.
So and it doesn't mean that that's for the companies themselves. That's a great strategy, reinvesting in that thing, and for shareholders who hang on to it, if they remember to sell, if they have some discipline and say, I'm going to make a profit on this and I'm going to do something else to get myself some income, and then if I have money left over, I'll buy some more Amazon again and do it again. But they got to take a little bit out all the time to grow that portfolio to get to where they want to be income wise.
So how does a person I mean, it sounds like even you had a partner in this. So if somebody's interested in this, should they be working with somebody to help them? I mean, is this something they can figure out on their own?
I always had, when I was in the business of managing hundreds of portfolio's, I had to have somebody in the business because I couldn't do that myself.
Yeah. Okay.
You know, you had to get registered investment advisor, but you had to put your shingle with somebody else, with a brokerage firm. So I had to work with Rita, then I had to work with Ken. Okay. You know, so you didn't have any choice. So, and they did all the back office work. So that's why they got the lion's share of the fees. I got about a third of the fees, and they would for while they were getting commissions, and then the commissions went away, and then they were getting a per piece of the fees. But they did all the statement work, all the record keeping, all the legal stuff. I mean, that's a lot of work.
Yeah. And
the trading, my God, I still do. In a good market, I'll do 40 or 50 trades, my own portfolios. We used to do 200 and 300 trades a day, buying and selling.
Okay. Yeah.
So they had 4 people in the office running our portfolios. I mean, I was managing myself 110 million, and Ken had another 100 million of his own old customers, and this other guy, Matt, had another 100 million. So we were a pretty big outfit. You know?
So this is a strategy you'd recommend to any age group? I mean, this isn't like...
I guess the most important time to think about income more than growth, ironically, is the younger you are.
Yeah.
Because people who don't know what they're getting into can be easily taken advantage of and speculate. And they're their own worst enemy, because they'll call a broker and say, okay, what's hot?
Yeah.
Get me some of that. Here's my IRA contribution. Buy me what's ever really going up, and stuff like that. And no real plan, no real, So my solution is you go out and you buy a book like Retirement Money Secrets, and you learn about the securities that you're going to own, and you learn about quality and how to diversify and how important income is and stuff like that. And then you learn about profit taking as well. Yeah, it's not easy. You have to really get a feel for it, and our education system doesn't do that for you.
Yeah, right.
I mean, you're lucky if you come out of high school and know how to balance a checkbook.
Yeah, except nobody uses one anymore, so you don't even get that.
You don't have to anymore, right?
Yeah, no, absolutely. I think we talk about that to some extent on every show. So it's good. It's a good thing there are other ways people can educate themselves around money, because we're not doing a good job.
Yeah. So, but there is a lot of knowledge out there that you can get. It's not, you got to look at Google and Wikipedia type stuff. And sometimes you have some misinformation. Somebody showed me a Wikipedia article the other day, and the first thing it said was, in talking about closed-end funds, it's closed-end mutual funds. They're not mutual funds. They're totally different than mutual funds. So I just said, I'm sorry, this guy is, less than an expert in this field.
Yeah.
Well,
so if people want to learn more about this, it's super intriguing. I want to learn more. They can get your book, which, again, the title of your book, there you go, Retirement Money Secrets. Thank you, Tony. Yeah, that's, and you can buy that anywhere, I'm assuming, Amazon.
Right, anywhere.
Okay. And so that'll walk you step by step through this process. And can people also get in touch with you? How are you helping
There's
people?
Two ways, actually, now, particularly for people who have read the book. You have my website up there, theincomecoach.net. That's, to talk to me, to get some assistance, to review what you've already done, get your answered questions, or to just sit down and we'll take a couple hours and we'll coach you to how to get this whole project done. Like I meet with people like 3 or 4 different times, and by the 4th or 5th time, I just say, you don't need me anymore. And that's where I want to get to.
Okay.
To the point where I can say, you don't need me anymore. Email me a question now and then, that's fine, but you got it. So
that's
that
great.
way. And then what we're working with now is we develop a community called the RMS Income Investing Community.
Okay.
RMS for Retirement Money Secrets. And people who join that are literally getting the equivalent of a college education in income investing.
Wow.
We're developing a 12 series course of study and periodic Q&As on all kinds of subjects. Like the one on the 28th is going to be how do you determine your performance when you're an income focused investor rather than a market value focused investor. So, and we've done one already Q&A. The first course development session is on the 16th
of January.
Yeah, and we're going to be talking about how you use this. There's a website called CEF Connect, which lists pretty much all the closed-end funds that are available, and you can use it to research and to determine which ones you want to buy. So you can look at them and look at the quality, look at the diversification, look at the income it generates and for how long and stuff like that.
Very cool.
And the volatility that you want to see. for taking profits and stuff. So we're going to look at how you take those things to develop a selection universe for tax-free investments, for income, regularly taxable, and for equities. And how I went about developing the universes that I have that they get for free when they join the community.
Wow, that's exciting. So if they go to your website, they'll find information on this?
They'll find a link to the community as well, yeah.
Okay, that's great. That sounds like a really great way for people to educate themselves further on this topic.
Yeah.
So, okay.
On this topic. And the general principles, the QDI, I mean, that goes as well with anybody who's just in the regular stock market as well. And all of what we're going to talk about, is based on the securities that you have out there at your disposal and how you go about obtaining them.
Mm-hmm.
Yeah.
Yeah.
So, yeah, I think so.
Okay. Well, thank you. That's amazing. I think that that sounds like a really great way for people to get involved in this and really be able to ask questions and learn.
Yeah, we just started early in December, and it's, we've got over 200 people in it already. So.
Okay. Wow.
So
that's great.
It's a good one, so we think, anyway.
Yeah. Okay. Well, it sure was a pleasure having you on. This is really interesting. And I feel like it, I don't know, it feels like a very comfortable way for people to, get involved and have this income that they can see that's tangible. And it isn't sort of a hope and a dream for the future.
Yeah, you got it. Yeah, I think that's the way it is. You feel secure that it's generating this additional income and it's a growing stream of income. And eventually you can either say goodbye to your employer and do something yourself or retire early. It gives you that confidence going forward, I think, when you have that security of an income that's not dependent on an employer.
Yeah, absolutely. Especially in today's world. I mean, employers, there's not the same situation.
I haven't had one in so long, I don't know.
Well, it's different. You can't rely on them to have a job for you forever. So, Well, Steve, thank you so much. This has been a great conversation. I'm so happy that you were able to join me here today and enlighten people on this. I don't think we talk about this enough. This definitely hasn't been a focus, for any other investment managers and wealth advisors that we've had on. So this is great. Something.
Okay. Well, good.
Yeah.
I hope it spreads. That more people
well, we'll try to spread it.
Interested in the income, and I hope the fire stops spreading and that you guys out there stay safe.
Yeah, thank you so much. We feel that way as well, and I appreciate that coming from. We're hearing that coming from different parts of the country, and it's very heartwarming to know that people are sending those.
We're all thinking about you.
Yeah, thank you so much. Okay, well, listeners, I hope that you're going to grab Steve's book and check it out and see if there are some new ways that you can think about your retirement and the way that you can generate income that could possibly replace your job. That's always an enticing idea. So, and it sounds doable. We're just spent the last 45 minutes talking to somebody who did do it and has helped others to do it. And Steve seems to be making himself quite available to people, both through personal coaching and through his new group. So check him out. And and please continue to listen to the Money and You show. And if you liked the show, think somebody wants to listen in as well, please share the show, give us a rating and a review. We would love that. We can continue to bring great guests like Steve to the Money and You show with your help. So thank you. And we look forward to a great 2025 with all kinds of wonderful additional topics and really digging further into how to find financial well-being and financial freedom in your life. So thank you for joining us, and we'll see you next week.